This is 10 years hence. My name is Jim O'Rourke. I am a faculty member in the Department of Management and director of the Fanning Center for Business Communication. I'll be your instructor and your host for this lecture series. We have arranged for you a series of 7 lectures that I think you'll find interesting and exciting. Our aim is to engage in some structured speculation about the future, specifically the decade just ahead, and the world we're likely to inhabit 10 years from now. We'll do that from a number of perspectives, but all of it will be focused on one theme: the future of capitalism. Our speakers come to us from many parts of the nation and all walks of life. Scott Malpass is Vice President and Chief Investment Officer of the University of Notre Dame. Richard Mendenhall is the Fred Duda Professor of Business and Chair in the Department of Finance in the Mendoza College of Business at Notre Dame. Harris Diamond is Chief Executive Officer of Weber Shandwick, the world's largest public relations firm, headquartered in New York. John Rosenthal is Chief Executive Officer and Managing Member of Rosenthal Partners Capital Advisors in South Bend, Indiana. Paul Schultz is the John W. and Maud Clark Professor of Finance in the Mendoza College of Business. Fred Dust is Partner and Practice Lead for IDEO, a global design and innovation firm headquartered in San Francisco. Hazel Henderson is founder of Ethical Markets Media and lives in North Carolina. John Mackey is Chairman and Chief Executive Officer of Whole Foods Market Incorporated in Austin, Texas. And Catherine Mathis is Senior Vice President of Marketing and Communications for Standard & Poor's in New York City. We'll gather here on 7 separate Friday mornings during the spring semester, beginning promptly at 10:40 a.m. each morning and concluding about noon. In order to make this a productive, useful experience for all of you, I have a couple of requests. First, please plan to arrive here on the scheduled lecture dates before 10:40 a.m. I'll mention cell phones in a moment. We will begin promptly at 10:40, and I'd like you to be in your seats and ready to listen at that time. Second, please pick up a copy of the syllabus available at the tables as you enter or at the center of the room. If you're enrolled for the course, I've emailed you a PDF version of that document, which you'll also find on the Mendoza website. Double check the dates to make sure you don't get up too early and arrive here on a day when we have no lecture. That's been known to happen. Third, please give our guest lecturers your full attention and complete courtesy. That means, of course, my preference for you to be fully awake and engaged in the process. No trips outside the lecture hall, barring a genuine emergency of some sort. Fourth, please turn off your cell phones, pagers, iPods, and yes, your laptops. Please see to it that nothing electronic interferes with our ability to learn. Fifth, if you are enrolled in this course for credit, you'll be required to attend all 7 lectures. I will handle exceptions to that rule personally. There will be no unexcused absences. Even if an absence is justified, excused, and documented, you will need to make up the work by attending and summarizing either the lecture online or another lecture on campus. And finally, if you're enrolled in the course for credit, you will receive a color-coded stamped attendance card at the beginning of each lecture. Please print your name on that card along with the last 4 digits of your student number. At the conclusion of each lecture, we will place receptacles for those cards at each of the entrances on both the first and second floor. Please deposit your card as you leave. If you do not deposit the attendance card, you won't receive credit for having been here. When our speakers conclude their remarks today, we'll offer you an opportunity to participate by asking questions. We'll have wireless microphones, as you can see, available for you, and we'll ask you to wait for an attendant to pass one to you. Today, we would like to introduce you to the work of a brilliant young Harvard economics professor named Neil Ferguson. He is the best-selling author of a number of important books, including The House of Rothschild, The Pity of War, Cash Nexus, Empire, Colossus, and The War of the World. This morning, we'll focus on his most recent work, The Ascent of Money, which has appeared as a popular television series both in Britain and the United States. Our plan is to show you 6 of the early segments of this series, totaling about 47 minutes altogether. After watching these video segments, we'll ask our 2 guests this morning to offer a few thoughts of their own and then take questions from you. Our guests include Scott Malpass, Vice President and Chief Investment Officer of the University of Notre Dame. Mr. Malpass is responsible for the investment of the university's endowment, working capital, pension, and life income assets of almost $7 billion. The endowment of some $6.2 billion is the 14th largest in American higher education and the largest at a Catholic university. Mr. Malpass is a 1984 graduate of Notre Dame and received a Master of Business Administration degree from the university in 1986. He returned to Notre Dame in 1988 following employment with Irving Trust Company on Wall Street. Our second guest is Richard R. Mendenhall. Rick is the Fred V. Duda Professor in Business and Chair of the Finance Department here in the Mendoza College of Business. His research examines the role of public information in setting stock prices and has been widely featured throughout the financial press and the mainstream media. Rick is a graduate of the United States Naval Academy and holds both MBA and PhD degrees in finance from Indiana University. Let's begin this morning with the first of our video segments narrated by Professor Neil Ferguson from The Ascent of Money. Well, our thanks to Professor Ferguson and to PBS Television. Let's move now to our guest commentators, and we'll begin with Scott Malpass.
Rick's going to start.
Oh, okay. The vote has been taken. It'll be Professor Mendenhall. Rick?
Thank you. Can you hear me? Okay. Our assignment was, I think, intentionally vague, just to make a few comments about this topic. I have one slide on just a critique of what we just saw, and then I have some general comments about my take on the financial crisis, and I will hit on some of the other topics. So let's get started. I know my time is limited. Oh, okay. I found this video to be very interesting. Professor Ferguson is obviously an engaging speaker, high production value. I kind of like the David Lynch-like music in a couple of places. I'm not sure what using seashells and clay tablets as money has to do with our current crisis, so I don't think we had to go back quite that far. Shylock, really? Same comment. I'm not sure I got a lot from that tells me about securitization or why we're in the mess we're in. I thought there was a little too much George Soros. He is a convicted felon, in case you didn't know. Insider trading in France. The jump from the Medicis to Memphis, I think maybe Professor Ferguson skipped over 1 or 2 important things in that whatever 400-year period. Given the scope of all the topics that were covered, I think this was a necessarily superficial video, and I have a promising note. I end this slide on a promising note. In my opinion, next week's part is better and much more controversial. I think that you'll enjoy John Rosenthal and Paul Schultz's comments on next week's segment, which is the second half of this video. Let me continue. This is my view of the financial crisis based on what I've read, the people I've talked to. What happened? There was too much money chasing too few investments. Banks looked for assets to turn into bonds. Lenders were highly incentivized to make loans that could be combined, sliced, diced into bonds. Okay, because there's so much money, the bankers say, we need places to put this money. They wanted more bonds, and so they went to lenders and said, hey, we need more places to put this money. The lenders said we're highly incentivized to make loans. Lenders pushed loans on people that the people could not afford. Couple the fact that lenders were incentivized to make loans, along with, as Professor Ferguson pointed out, the government was pushing loans. The government officials were pushing home ownership. Why? Because they think it's a good thing. It makes people responsible. It makes people buy into the economic system. Fannie Mae and Freddie Mac were directed to make loans to low-income people. And possibly, again, as the video suggests, the government felt it was making up for past discrimination. The bottom line is that people took out loans they could not afford. What was the lender's rationalization? Borrowers will be able to afford the loans, not because they have sufficient income, remember the ninja loans, but because interest rates will stay low and because house values will continue to go up and people can refinance later. That is, as their house values go up, they will have additional equity, they can refinance, and even though they can't afford their current loan, they'll be able to afford the next one. Let's take a quick look at real U.S. housing prices. What do I mean? I mean extracting inflation. What has happened to the price of houses in the United States since 1890? And this comes from Bob Shiller, a Yale economist. Now take a look at this picture. This starts at a value of 100 in 1890, and it shows the real value of U.S. housing. Would you look at this picture and say, oh, I think here we are in 2006, just a few years ago. Would you look at this picture and say, I don't think housing prices can ever fall? I know we have the benefit of hindsight, but I don't think I would look at this and say, oh, I think it's going to go to 400. And of course, now we know that it didn't. Okay, we know that housing prices have fallen. I certainly wouldn't bet the farm on housing prices continuing up from where they were at that time. But as the video points out, lenders were not that concerned about borrowers being able to repay. Why not? Moral hazard. There was a separation between those initiating the loans and those benefiting from suffering the consequences. Lenders quickly sold the loans to financial institutions. Financial institutions securitized the mortgages. Professor Ferguson explained that very briefly, but I have a slide here that I think will clarify the whole securitization process. Now, it's a very simple slide, so just take a look here. There we go. Okay, I put this in for comic relief. I thought you might need some by now. And this is a diagram of a securitization, but the principles are pretty simple. The details can be pretty complex. Okay, so lenders are incentivized to lend. Fannie Mae and Freddie Mac are incentivized to lend. There were too many mortgages. There was too much home building, an oversupply of houses. So we have declining demand and oversupply, falling house prices. Couple falling house prices with increasing interest rates, and what do you get? Greatly increased rates of default. That means the value of these mortgage-backed securities tumbled dramatically because they're based on people paying back their mortgages. When people don't pay back their mortgages, the values fall dramatically. Institutions certainly played a big role in this. Over-leveraged institutions were forced to dump other assets. As the value of their mortgage-backed securities fell, they had to come up with cash. They had to dump other assets. That's why this crisis affected not only the real estate markets, but started to affect the stock market, et cetera. There was a severe loss in faith in financial institutions, and as the video points out, trust is central to financial markets. There was a loss of trust on which financial markets rely. Financial markets rely strongly on trust. When it's lost, we're in bad shape. Okay. Thank you. Enjoy the rest of the course. Enjoy the comments of Scott Malpass, and I'll end here. Too kind.
Thank you, Rick. Can everybody hear me?
Blank screen.
I agree with everything that Professor Mendenhall said, and let me just add a couple of other things. First of all, I'm a global long-term investor, so I have a different perspective than a lot of investors. I have a much longer time horizon. I'm looking for long-term value and cheapness and inefficiency. So I'm already skeptical of anything Wall Street is packaging and putting out. Having said that, as we analyze what happened during the global financial crisis, like a lot of innovation on Wall Street over the years, securitization and other concepts that expanded credit and leverage went too far. The regulation, there should have been more regulation. It just went too far. But Wall Street's always going to follow the rules of the game as far as they can. And it's just throughout history, and the film tried to give a sense of that. There's boom and bust. They're always going to follow the rules of the game to the very, very nth degree. And at some point, people realize that's too much, and there's a bust period, and there's more regulation. And so, what will come from this is obviously a lot of new regulation on Wall Street. Having said that, though, I do think securitization was a very important part of the global economic expansion of the last 10, 15 years. Done properly, I think it plays a critical role in providing cheaper credit to a broader array of people. It certainly will be important to the recovery and expansion going forward. It's not going away, but it has to be done much more thoughtfully and carefully with more transparency, better underlying collateral, more reporting, et cetera, than existed over the last several years. It's like a lot of innovation. You credit default swaps, other instruments, other derivatives that Wall Street has devised to transfer risk. It had a bad ending because it went too far, too much leverage, et cetera. But I think the core concept in terms of providing lower cost capital, making credit more available, spreading risk, encouraging economic growth, all of that is still valid. All of that will be important to the global economy going forward. And I'm glad that we're going to have some increased regulation. And I'm a pretty free market person, but I also recognize that you just can't have unregulated activity in everything that Wall Street's doing. You do have to have some limits on what can be done and some protections for the naive investor or for the smaller person or the unsophisticated. And I think it was a mistake to let it go as far as it did. So those are my comments, and we'd be happy to take questions from the audience.
Okay. If you have questions, we have microphones and attendants to bring those microphones to you. We have a question right here.
With what we've seen in the last, I suppose, this week, and with the election of a Republican from Massachusetts, do you think that that investor confidence in the regulatory system as well as the financial systems is falling? I mean, we've kind of lost our gains from 2010, or I don't know, will stock market prices go back up? I suppose that's a rather difficult thing to ask.
No, I mean, obviously, we're all thinking about that, right? We're all trying to figure that out. And people have short memories, most people. And so I think you've had a big 60-something% run in the stock market since March. And that sort of delayed the regulatory process, I think, because all of a sudden it looked like things were okay. But the underlying problems are still there. And, of course, the economy is very weak. And there's been no job growth. We might have more job loss before that gets better. And the recovery, any recovery we have, may not necessarily entail a lot of new jobs. So I think people are still concerned about the global economy and how this will play out over the next year or two. There's a lot of concern about overspending by the government. That's inflationary. So companies are just reluctant to make a lot of long-term commitments and new capital projects, which I think will hurt hiring and job growth. But we're all trying to figure that out a bit. What does all that mean for the next couple of years or the next 3 to 5 years?
I think there's some positive signs about investor confidence, but I think we're early. Obviously, the stock market had a very good year in 2009. I think it's probably still up this year after the blip we had following the president's speech the other day. But I think that's a positive sign. I also look to implied volatility on index options, and if you look at a history of that, it has been falling. I mean, it was incredibly high at one point, and it's now been falling. So I take that as a positive sign about investor confidence. But there's certainly still a lot of uncertainty. That'd be my take.
Just a quick follow-up. I guess, does that, what about the disconnect between unemployment and the market going? Is there going to be a difficult
The easy question to that is, or the easy answer for that is that the stock market is a leading indicator. That makes sense, right? If it was a following indicator, we'd all be rich. But it's a leading indicator, and employment is a lagging indicator. So it's a positive sign. Although the stock market's often wrong, right?
One of the things I'd like to have a comment on is how gold plays in the global economy. For example, when Nixon took us off the gold standard and made us fiat, typically the economic model is that the fiat currency decreases by 75% in 40 years, which is where we are right now. Both India and China have been dumping dollars to buy gold. And now China has made it possible for private citizens to actually own gold. So I'd like you to comment how you think gold is going to figure in with our currency and now that we're very global.
Yeah, no, it's a very good question. I mean, from a pure investor standpoint, gold has no intrinsic value. You know, it's only worth what someone's willing to pay for it. It doesn't have cash flow. So it's been a very unique asset in among precious metals and other industrial metals or base metals. So it's a very unique asset. It really is a monetary asset. You know, at the end of the day, if people believe U.S. dollars are going to depreciate, then the only asset better than that they believe is gold, because there's no other currency. You know, the euro, the yen, these don't look very good either. If you think about their current economic situations. So we own gold as a sort of a hedge against inflation or as a hedge against a massive depreciation in the dollar, but I don't believe in gold as sort of a long-term value play. It's truly sort of a monetary asset and a hedge against inflation from a pure investor standpoint.
Yeah, I agree, and I think gold's a risky play at any point in time. Remember, gold was, I don't know what gold is now. Is it $1,100, something like that? $1,100 an ounce. It was $800 an ounce in, I think, 1980, 80 or 81. I can't remember. So it went down, it languished, and now it's come up. I think it's unpredictable. Who knows what? When I see advertisements on television all the time to buy gold, that strikes me as a bad sign, right? That's a bearish sign for gold for me. But I think the actions of governments like China could easily overwhelm that. So that if you can predict what they're going to do, and then maybe you can predict the price of gold. I can't.
Are there other questions?
Can you comment on the future of what regulation should look like, given the inherent revolving door and conflict of interest between regulators and investors? Maybe just what the what the model should look like. Maybe do we incentivize regulators in the future?
I think the answer to that question is very complex. We have just initiated a center in the finance department, the Center for the Study of Securities or for Financial Regulation, and I think that the actual answer to your question is not. I can't give it in just a few words. I think what I would like, in very general terms, I would like to see regulation that doesn't inhibit markets from doing what they're supposed to do, doesn't inhibit prices from working, doesn't inhibit people from trading and institutions from trading. We should allow people to trade. We should allow prices to move, but we shouldn't allow institutions to take on extremely large risks. I mean, the banking sector has almost always been regulated, and for good reason. And I'm going to go back to something Scott said. He said he's pretty much a free market guy, but he doesn't mind seeing more regulation. And I agree with that. I don't know if I want more regulation, but I want better regulation. And people sometimes say, well, you can either be free markets or you can be for regulation. I think that's ridiculous. I think that capitalism requires regulation. We have to have property rights. We have to have bounds on what institutions can do. But I think I'm not good enough to answer I'm not smart enough to answer your question. I think that is a very complex answer.
If you could wait just for the microphone, primarily not just to be heard in here, but because it's being recorded, your question wouldn't be captured. Thanks.
Sorry about that. I was wondering if you thought maybe getting rid of naked puts and calls would help stabilize, since so much speculation goes on in options. If that would help, getting rid of naked puts and calls.
No, I don't think so, because you mean exchange traded options?
Right, to get rid of the naked ones that have
no one is
financial backing.
No, I don't think so, because if you're trading, a naked option means that you don't have an offsetting position, and if you're trading those, you have to put up margin. So it's not like they're totally unregulated. I mean, if you buy or sell, if you sell uncovered options, you have to come up with money. So that market is, I think, sufficiently regulated, and works very well.
Yeah, I would agree with that. It's also, again, it's the leverage people use that tends to exacerbate the directional movement of those things, and that's where the problem comes in, and they don't have the collateral. It's not the instrument itself; it's how it's used and executed. It's sort of like, hedge funds seem to have a bad word among some people, but they provide tremendous liquidity to markets. They enhance price discovery. They're very good shareholder activists. So I think they play an important role. But again, over-levered and done improperly, they're not good. So you can't it's hard to generalize on some of these things.
And I'd like to comment on Scott's comment about hedge funds and go back to his comment about securitization. I agree that both of those things are good things. They just have to be used properly. Securitization itself is a very good thing because it allows for spreading of risk, a lack of less dependence on geography for mortgages, et cetera. It's a very good thing, but it can be misused, as we've seen.
Going off of recently, President Obama has been trying to push the regulation on banking, and it's been on the news recently. First of all, it's been very controversial, so do you think it will actually pass? Are you for it? Because he's been trying to place a lot of regulation on banks, especially that are risk-reward type banks. And do you think that kind of regulation is too extreme, or are you in support of that kind of regulation?
I would say what I've heard most recently in the last couple of days is too extreme. I am for some division of, deposit-based institutions that are intended to be safe for the average American, if you will, the average depositor. There has to be protections there. But I don't think those banks should be inhibited from providing credit in a thoughtful way, in a properly regulated way. I think somebody suggested they shouldn't be able to have prop desks. I don't agree with that. I think that's too far. But again, I think some more oversight of how those function is useful. So again, it's not all or nothing. It's being thoughtful about it and really attacking where the problems were, then regulating that and not throwing the whole thing out. I'd hate to see it go too far.
Thank you.
My last question, I promise. How has the university's position changed since the summer of 2007?
In terms of our investment strategy?
Yes.
It hasn't changed at all in terms of our basic long-term philosophy, as a value investor, looking for really good investment partners and take a piece of our endowment pool, people with real skill, have integrity and character, et cetera. I think, though, in the reality of the world over the next 5 to 7, maybe 10 years, there's going to be a lot more periods of up and down. I think that you'll see more volatility. more extreme moves in both directions because of all the uncertainty in the global economy. We still have trillions of debt that has to clear the market. The banks still own all of this bad debt. They just haven't had to market because of the government programs and changes in the accounting rules, et cetera. So there's still a lot of work out to be done. And then you think about the commercial real estate market. So I do think there's going to be a lot of volatility and extreme movements. So we may have to be a little more tactical, a little more opportunistic. When things run up, take more profits faster, and then look for dips to go back in. So we're being a little more tactical, a little more trading oriented than I think we have had to be in the past. And that's not bad. It's just you have to be very vigilant and really in rebalancing and really stay on top of what you have. So that would be, I guess, a bit of a change from the past. But the core philosophy and our playbook has not changed at all.
Other questions? Got one right here.
Hello. We've heard that almost all this crisis is coming from the subprime here in the U.S. Professor Mendenhall has added that it's coming from this massive flow of Chinese funds, but we are in a global economy, everybody's affected, and beside this issue in Norway, what else has been involved in the international markets of money to create or to mitigate the effects of the crisis?
What's it?
You're talking about other related subprime kinds of things that are happening in international markets?
It happens to be that, especially in Europe, it's seen that everything is coming from the U.S., and we are not guilty in Europe. We are just suffering from these bad guys from the U.S., and it's not like that. So everybody has it part of the big deal. How is it spread?
Well, that isn't entirely true, of course, right? But I will say, from my experience with the Europeans and investment firms in Europe, they do tend to adopt a lot of the same strategies, but it's sort of a beta of two. They sort of way overdo it beyond what we did, so they make it that much worse. And of course, the Chinese are very regulated in their markets. Their currency is not freely tradable, and they're very, very regulated in cash movements. Does that answer your question? Sorry.
I'll say what I often say. We can talk after class.
Yeah.
Scott, I have a macro question. Looking more short term here, the U.S. certainly has been the leader for some time in terms of generating global economic growth. It seems like a lot of key fundamentals here point toward weak domestic growth. How much can we look to Asia, and specifically China and India, in getting some reverse growth back here into the United States as we look to the future? I mean, long term, we know that's inevitable, but what about the short-term phenomena we're looking at?
No, I think the U.S. will always be at the middle of economic growth. I mean, our economy is so broad and so rich and so deep, and the rules of the game are so well known and established, and the legal aspects of the protections. So I mean, we're still the largest country of foreign direct investment, But having said that, I mean, the demographics aren't as appealing as, say, Brazil and China and India. So, probably half of the world's growth over the next 20 years will be from more the emerging world. And we worked very hard over the last decade to position ourselves very, very well in those markets. We have fabulous partners in those markets. I do think a lot of the success we'll have in the next 10 to 15, 20 years will be a greater proportion from those markets than the U.S. that we've seen over the last maybe 20, 30 years. Of course, the U.S. market's down over the last 10 years, and so it hasn't been very profitable over the last decade. Just an average index investor, is down. So again, that's that trading thing too. You're going to have to capture profits when you can get them, and then reinvest and be more vigilant of market movements.
I think we may have time for about one more.
Hello. Some people have criticized the role that the MBA programs have played in the financial crisis, just some of the training that the MBAs have received over the last 20, 30 years. I guess what's your response to that, and how do you see the curriculum potentially changing in the next 10 years, or how that will be responded to?
I really do not see MBA programs, MBA curricula responsible for this crisis. I understand others may take a different view, but my view is that I've been involved with our MBA curriculum for quite a while. I teach a core class in the MBA program, and I think that none of the causes of this come out of the curriculum. We give students tools, but I hope in this college especially, we talk about ethical behavior and we talk about responsible behavior. And I think what caused this crisis is to a large extent a lack of knowledge, a lack of common sense on a huge scale, like the picture I showed of housing prices. Would you make the prediction that that's going to go to 300, or is it more likely to go flat or go down? But it's also, there was a lot of greed involved and a lot of misbehavior. And certainly none of that comes out of the MBA curriculum. So I've staked out a position where I do not think MBA programs are responsible for this crisis. As some people have said, there's enough blame to go around. But I don't, let me put it this way. I don't see what we're doing that could have caused this. And I think we're doing a lot of things that if people had learned those lessons and followed them, we would not have had this crisis. That's my opinion. I hope it's not too self-serving, since I am involved in teaching in an MBA program.
Two more things for us to do today. First, let me invite you to join us in 2 weeks' time for Professor Paul Schultz and for Mr. John Rosenthal, who will comment on the last half of the Neil Ferguson video. So 2 weeks' time from now. And secondly, let me ask you to join us in thanking our guests for today.